अरे सर, कोई बढ़िया कमर्शियल प्रॉपर्टी दिखाओ ना।
ये प्रॉपर्टी है ना, ये परफेक्ट है आपके लिए।
बढ़िया तो है सर, कितने तक का रेंटल इनकम आएगा?
फिर साल का 1 करोड़ का रेंट तो मिल जाएगा।
सही है। और प्रॉपर्टी कितने की है?
1 करोड़।
है?
And that's the PE of 1. I first read about this concept in a tweet by Mohnish Pabrai and have been fascinated by it. I mean, look at it this way. There are about 4,000, 5,000 companies on the Indian Stock Exchange. Now, if I tell you to bring me a list of companies with a P ratio of 50 or below, then you'll come back to me with a few thousand companies. A P of 40, 30, even 20 is likely to yield over 1,000 entries. A P of 10 or 5 would bring this list down to a few hundreds. But a P of 1 would have just 17 companies from the original list of 4,000 plus. But these 17 companies are the ones which have a visible P ratio of 1. That is, the company's share price is equal or less than the earnings per share of the last 12 months. However, when Mr. Pabrai says a PE of 1, he is actually referring to companies that have a hidden PE of 1, that is, companies that are at a high PE now, but it's very probable that their future per share earnings will be higher than the current price per share. For example, let's say our property dealer were to say, इस प्रॉपर्टी के सेलर का एक्सपेक्टेशन 2 करोड़ रुपए है, which means the building is available at a PE ratio of 2. But now let's say he adds another piece of information. वैसे तो टेनेंट्स के साथ मेरा नेगोशिएशन हो गया है, क्योंकि ये प्रॉपर्टी प्राइम लोकेशन पे है, अगले महीने से इस पे सब लोग डबल रेंट देंगे. And that's how a hidden PE of 1 works. The point, and Mr. Pabrai puts it very well when he says, if you have a bunch of stocks at a PE of 1, then generally good things will happen to you. And so in this video, we shall understand this concept in a little more detail as we figure out how to identify such companies, what are the things one should be cautious of, and also take you through an example of one such company which I think has a hidden PE of 1. Let's begin. The P ratio is often the most loved and talked about valuation metric. But if one thinks through it, what are we really doing? We are taking the present price, we are dividing it with the past earnings, and we're doing all this to help us gauge the future returns from that stock. Doesn't sound very logical, does it? And that's because it's the company's future earnings that will determine how good or how bad your return on investment is. In fact, let's look at it from a PE of 1 perspective. So we have this company Avenue Supermarts, which is at a current P ratio of 112. It looks a bit expensive, and this company's PE has been over the 100 mark for many years now. But what's also true is that DMart has been growing its earnings every year at an average of 25%. So if the company is earning 1 rupee this year, it can potentially earn a rupee and 25 paise in the next year, then 1.56 rupees in the third year, 1 rupee 95 paise in the year after that, and so on. Which is another way of saying that DMart will reach a PE of 1 11 years from now, assuming it continues to grow at 25% per year. Now we can do this extrapolation across a range of companies, and what I saw was that getting to a PE of 1 was an excruciatingly difficult and time-consuming exercise for most decent-sized companies. Which brings me to 4 things we can learn from this. 1. The primary variable in our quest of finding hidden PE of 1 companies is the profit growth. And as we saw in the case of Avenue Supermarts, Varun Beverages, even IRCTC, companies that are growing their profits by more than 20% are more likely to get there even if their current PE ratio is a bit on the expensive side. My second learning is that the starting point matters. I mean, look at this table where I have mapped different combinations of PE ratios and the earnings growth rate. The idea here is to see how many years a company will take given its current PE and profit jumps. And to set the context, a company at a PE of 100, which is growing at 20% per annum, will take more time to reach a PE of 1 as compared to a company which is growing at just 10% but is presently at a PE of 10. Which means while having a high growth rate helps, starting off with a low valuation, a low PE ratio vastly improves the company's chances of getting to that PE of 1. My third learning is an extension of the first and second point. So we saw some companies that can potentially reach a PE of 1 over the next 10, 20, 30 years. But truth be told, a multi-decade plan does not sound very exciting, at least to me, because anything can happen along the way. There is competition, change in consumer demand, technology-led disruptions, natural calamities, regulatory changes, etc., which can upset even the best laid plans. Which means ideally, we should be looking at companies that have a 1P visibility over a maximum of 5 years or maybe 6 years. And the fourth learning, at least from looking at our table, is that a hidden P of 1 might be more visible in mid and small cap companies rather than the large cappers. So armed with these 4 learnings, I went to a standard stock screener and plotted what I thought would take me close to a PE of 1. I used a combination of P ratio and earnings growth, and although I haven't analyzed every company in this list, on first glance, all I could see were high debt levels, unstable operating margins, and even corporate governance issues, which weakened my entire case of finding a PE of 1 company, at least in India. And so I went outside of India to neighboring China, where there is one popular company which seems to have that hidden PE of 1 in it. Alibaba Group Holdings Limited has endured a tough time in these last 2 years. The market valuations have dropped by almost 80% from its all-time high, and the company continues to face many headwinds on account of geopolitics, President Xi's re-election, China's COVID policy, regulations, etc. But this doesn't hide the fact that the company is still highly profitable and it now trades at dirt cheap valuations. So at the time of recording this video, one share of Alibaba was being traded at $65. The company also has a net cash position of $70 billion, which comes to almost $10 a share. This means on a cash adjusted basis, one share of Alibaba is priced at $55. From an earnings standpoint, the consensus estimate is that Alibaba will close FY23 at an EPS of $7.11, which on a cash adjusted basis gives us a P ratio of 7.7. Over the next 5 years, the EPS is projected to grow to $14.29 per share, which gives us a P ratio of 3.8. Now 3.8 is a lot closer to our 1P milestone, but a further examination shows that there is something hidden even deeper in these numbers that can strengthen our investment thesis even further. You see, earnings can be of 2 types. The first is accounting earnings, which can be calculated from the company's profit and loss statement, which is what our earnings per share or EPS is all about. But then there is the second type, which we call as economic earnings, and this is represented in the form of free cash flow that a company generates. Now, I won't go into specifics of what a free cash flow is or how is it calculated. Maybe I can do a separate video on that. But when we compare Alibaba's free cash flow per share with its per share earnings, one can see a discrepancy where Alibaba's free cash flow numbers have been averaging a good 40% higher than its EPS numbers, which means the EPS estimate of $14.29 that we have for FY28 can be reconstructed as a hidden EPS of $20. So at a current cash adjusted price of $55, the hidden P for Alibaba now comes to just 2.75, taking us a lot more closer to our PE of 1 target. I think this is a wonderful example of how investors can construct an investment thesis, and it is my belief that a bunch of 1P or even 2P stocks can do wonders to your wealth creation endeavors. But let's be a little practical here. The fact is, a PE of 1 is an infrequent phenomenon. And as much as I would like to have an entire portfolio of 1P stocks, I'll be lucky to get a company like this once in 3 or 4 years. Now, there is always that temptation to open up a stock screener and try out different combinations. There's nothing wrong in that approach, but one has to be careful with cyclical businesses. And that's because a cyclical cannot and should not offer visibility beyond 1 or 2 years. The P ratio of these companies are quite volatile. And thirdly, in cyclical businesses, more than earnings, it's the demand-supply gap that determines the price. Which means when identifying PE of 1 stocks, try to focus on the more direct parameters like sales growth, profit growth, operating margins, etc., and offer extra marks to companies which have pricing power. Another set of companies you can examine are companies that were good once, are now in trouble, but with a small infusion of capital and good talent, these companies can spring back to normalcy. This is what we generally call a turnaround, and although there is some risk there, these companies can fit the hidden PE of 1 charter. So learn to look beyond the screener when finding such kind of companies, and always keep an eye for businesses that can reach a future PE of 1. I sincerely hope you found this video useful, and if yes, then do tap the like button. Please also subscribe to my channel, do share this video with your friends, and I look forward to seeing you next week. Until then.